Hey, US history! It is good to see you guys again today. Guess what? This is our final lesson for the school year. I know I'm just as blown away as you are too. This year's just flown by. This week, May 4th to the 8th, everybody has to cap their new lessons by the 8th. All your teachers do. Then the following week is going to be finals, and then it's book return, and that's it. We are so close to being done with the year. But I'll be honest, I'm not really that excited though. Like it's different. It's kind of sad because I haven't seen you guys. But at the same time, it is nice knowing that summer break is coming, and I'm just praying that things can get back to normal for the next school year. We did have our Zoom meeting. I had 3 of you came, so which is better than nothing, I guess. And thank you guys for who did come out, and I enjoyed seeing your faces through this. And I missed all the others, but I'll hopefully see you guys again soon. And the ones who did come will be getting bonus points, so kudos to you. Okay, so what are we going to do? Well, we're going to finish up our chapter 20. And sadly, this is as far as we can get with the circumstances. I had to slow my pace a little bit just to make sure I could, get it all in line. It's been kind of a weird deal. But chapter 20 is as far as we could get, so we're going to finish up the 1920s. And what we're going to do is today we're going to name the 2 major consumer goods that became commonplace in the 20s and how those things influenced American culture, explain the effect of advertising and speculation on American economic actions in the 20s, and then summarize some of the problems that contributed to the demise of the prosperity of the 1920s. So that's what we're going to be talking about today. If you haven't finished reading chapter 20, make sure you finish it. And at the end of this lecture, I'll talk more about it, but I'm going to have a final study guide for you guys. So definitely reckon it's going to be worth a ton of points. So this is enough to really help your grade if you're struggling, but it's enough to destroy your grade if you're not doing so well. So make sure that you pay attention to that and make sure you study. Okay, and before I jump into the slides, just as a quick reminder, we've been talking about the 20s, right? World War I had just ended. Warren Harding got elected pretty easily with his cry of let's return to normal, return to normalcy, to be technical. And Warren Harding wanted people to get away from idealism and all the craziness of Europe and get back to just a standard way of living in an American lifestyle. He died, sadly, and then Calvin Coolidge became president, and Calvin Coolidge said the chief business of America is business, and America started to boom. The Roaring 20s is what that's called, where people started to do well and business started to prosper. And then after Coolidge, Hoover takes over. And Hoover, remember the Hoover Rising from the World War I? He was the guy who was in charge of helping people ration their goods so that soldiers could have food. Well, Hoover becomes the president after Coolidge, but some really bad things happen, namely the Great Depression in 1929. So that's actually more the subject of next chapter, but I'm going to talk to you guys a little bit about that in this chapter anyway, because I think it's really important stuff to know. Okay, so what do you think the 2 consumer goods were that transformed America? If you go back to the 20s, what were the things that caused people's lives to change? What were the big things? Like, think about today. Think about how the internet has revolutionized everything. Think about smartphones, how those have revolutionized everything. Well, back in the 20s, the 2 things were the automobile and the radio. And a lot of you guys are thinking, those are boring. Everybody has a car, or who even uses the radio anymore? But in the 1920s, this is a huge deal. And we have to go back into their shoes to understand just how much life has changed from these things. Now, the automobile, we talked about Henry Ford. Henry Ford did not invent the car by any means, but even though that gets mistaken a lot. But what he did invent was a proper way to have an assembly line and to mass produce cars at a cheaper cost so that everybody could buy them for cheap. And that way more people could get cars, and that was truly a revolutionary concept. But what happened was when people began to buy more and more cars, installment plans were created during this time. And basically an installment plan, people still use these today. Hey, you want to buy this thing that's too expensive? Well, hey, 12 payments of $100 and it's yours. Or 12 payments of $300, whatever it may be. So people can basically get something now and then pay for it over the course of several months, usually with some interest. They might charge you an additional 3% or 5% on top of the total cost. But it's a way for you to get it and to manageably pay for it. And then also the automobile gave rise to the suburbs. Now, and urban, suburban, right? Urban is the city, like where all the, think about any city, think about Kansas City. You have all the buildings clustered together, but some people like to live further away from that, so they can be in a little bit of a quieter, safer neighborhood. Automobiles allow people to move away from the city, and then they could drive into the city, you know what I'm saying? Because if you didn't have an automobile, you're not going to be able to walk that or deal with horses. But cars allow people to actually go in and out of the city much easier. So suburban life became a reality during this time. Also the radio, a way that you could transmit information very quickly. I mean, think about this is just as revolutionary as Martin Luther in the 1500s in the printing press. Like when Gutenberg invented it in 1440, but in the 1500s you had the Protestant reformers were able to change the world using the ability to print stuff and disseminate information. Well, the radio does that even more effectively. KDKA was the first commercial radio station, and so people were able to broadcast all sorts of things on the radio. And this is going to become a huge deal in World War II with FDR's fireside chats, which we will not be getting to, sadly. But important thing to know. Skip that for now. Okay, so what about the effects of advertising and speculation? This is when you see advertising become a huge deal. People start advertising everything. I mean, and you think we have it bad today when you're on the internet, there's pop-ups, or you get all the billion ads in the mail, snail mail as they call it these days. At this time, people were just loaded with constant, hey, buy this, you need this will fulfill your life, this is great. I mean, you can find ads that look pretty similar to today's ads back in the 20s. And I wanted to point out from a Christian perspective here that this mass advertising caused Americans to spend a lot of money and to really focus on the present and indulging themselves in the present and not really caring too much about the future. And if you don't believe me, trust me, you'll see why I say that in a second. But let's care about right now. Well, go back to 1 Corinthians 15 for a moment. Paul was actually quoting the Epicurean phrase, eat, drink, and be merry, for tomorrow we die. The Greek philosophical movement of Epicureanism basically taught there's really no afterlife, there's nothing to be afraid of, so enjoy, and I'm not talking about a wild frat boy getting drunk every night, I'm talking about enjoy the good wine, enjoy good steak, enjoy good vacations, bring the maximum amount of wholesome pleasure to your life, because tomorrow it's all going to go away anyway. And that's what you see Paul dealing with in Corinth. Well, you see that happening in the 1920s as well, where people are so focused on indulging right now in the moment, because the future, who knows if they're going to even live to tomorrow, A, and B, who really cares beyond that? What about today? In American society today, I would dare say we still see that happening. You see people so focused on the now and the image they have, whether it be on social media or standard media or whatever, or making enough money or making enough influence or virtue signaling, but they care more about how people think about them, but there's not really a concern about the future. And I think that can be really damaging if you continue on that path. And as we'll see in the 20s, it definitely led to some disasters. And this is what I'm going to talk about. So speculation. This became really big in the 1920s. Speculation still happens today. I mean, me and my wife, we invest in speculation. We've already done it, and I'm sure some of you have too. Your parents probably do. Speculation just simply means this: you're buying something that's at a certain value now because you think in the future it's going to be worth more money, and you can sell it. Back in 2009, when we moved back to Las Vegas, Vegas is a really volatile sort of economy because when the economy is doing well, Vegas is booming. When the economy is doing poorly, Vegas sucks because 90% of my home state's revenue comes from gambling. So if people are gambling, lots of money comes in, but if everybody's having to tighten their belts, nobody's gambling. So we moved back there right at the tail end of the Great Recession, and we moved into a house. We paid $105,000 for it, and it had originally sold for almost $300,000. So it had plummeted in cost. Well, we bought the house knowing that when the economy started to pick back up, the house was going to be appraised for much higher. So we were able to buy a new house, live there for a few years, and then sell it when it had gotten some of its value back, and we made money on the investment. It was a pretty cool deal for us. That's speculation, and it could be, you see there's land, maybe in northern Missouri, that, hey, I hear that Ford's going to be building a new plant out in northeast Missouri or something. So you buy a bunch of land there that's for $10,000 an acre, and then, I'm making these numbers up, by the way, and then Ford buys it, and then all of a sudden people start moving there, then that goes from $10,000 to $60,000 an acre, and you can sell all that land for more money. That's speculation. Real estate, I think, is the best example. If you want to see, you have what's also called a speculation bubble. Sometimes when something is probably going to be worth a lot of money, a ton of people will overinvest in it, and it'll cause a big bubble where lots of money can be made, but then all of a sudden it collapses into actual market value when enough of that happens, and then all of a sudden people realize they lose all the money they had invested, and then they have nothing. A good example of that was the housing market. Back when so many people were buying, they were artificially spiking the price because everybody wanted it. But as soon as the credit died down and people couldn't keep getting money to buy more houses, all of a sudden the market collapsed to normal market value, and people were living in houses that they'd spent $400,000 on that are now worth like $100,000. That's an example of a bubble popping. And speculation can lead to that. When so many people invest in one thing, another example is the dot-com bubble of the late 90s, when people were investing in internet domains. So anyways, that's speculation in a nutshell. You also had, it's called stock investments. People basically, you have a big company like Microsoft, and what they do is it's called a going public, right? They say, hey, we're going to become a public company. They have, it's called an IPO, an initial public offering, where the company goes out on the market and everybody can buy shares or a little bit of ownership of the company. And typically you have the CEO, the people who really, I should say the CEOs, but the people who founded the company will usually own the majority of the shares, so they have the majority say. But any shareholder technically does own some of the company. And as the company's profit goes up, your shares go up in worth. So if you bought 1,000 shares of Microsoft for $1 each. Clearly, I know it's much higher, but keep it easy. And then Microsoft's profit goes up and those shares go from $1 to $3 each. Then you could sell those shares back and take all that money and you can make some good money in the investment. So that's what stock investments are. Another thing that's really controversial that still happens to this day, but not as much in the crazy sense, is called investing on the margin. And a margin investment just basically means this. I'm just going to pick on somebody in the class. I'll just say Thomas Pope. Thomas starts a tackle company for fishing, right? And I have a lot of faith in Thomas that his company is going to do well. So I want to invest my money because I know that if I invest money now and the profit goes up, then my profit will go up in the company as well. So what I do is I go to the bank and say, hey, I only have $10,000, but I want more money to invest in Thomas's business. So a margin investment would be basically where the bank says, okay, well, how much money do you have? Okay, you have $10,000. Do you want to do an investment on margin of 10%, 20%, 30, 40, 50, 60, whatever percent? Let's say that I wanted to do a margin investment of 50%. Then the bank would say, okay, you have $10,000 you're going to invest. 50% of $10,000 is $5,000. So we'll give you $5,000 on top of your $10,000, so that's $15,000, for a margin investment. And the goal, of course, being that, let's say Thomas's company really does well, then I'm going to make more money than I would have made had I not gotten that loan. Of course, the exact opposite can happen too. Thomas's company flops and I lose my money and then some. So you're probably thinking, well, why is the bank giving me money in the first place? They're not going to give you money. Well, the bank demands what's called collateral. Land, property, something that they can claim if you're not able to pay the margin that they gave you. So a lot of people in the 20s, because the economy was just booming and booming and booming, people started using their savings to take more money from the banks to invest way more on property and other things like that. So again, speculation, buying something now with the hopes that it's going to go up in value in the future so you can sell it and make money. Stock investments, owning some of a company and sharing in their profits. And investing on the margin, which is again the most controversial, is basically getting loans on top of your investments with the hopes of making even more money. And those are things that were very common in the 1920s. And I would argue again, by the way, you still see similar things happening today. Like back in, a lot of you were kids at this time, but like the first decade of the 2000s, a lot of people's houses, because there's so many people buying houses because of an availability of credit, that caused the housing market to skyrocket in value. Houses in Vegas, where I'm from, houses were worth $400,000, $350,000, and people were then in these houses with all this, that were worth all this money. So they were taking all sorts of, like another example is you could take what's called an equity investment. People were basically saying, okay, my house is worth $300,000, and even though I've only paid off $100,000, I still have, technically this house is to my name and I could sell it for a lot of money. So they would tell the banks, hey, give me a loan for $100,000 and you can use my house as collateral. So people were getting equity-based loans on their house. So that way, if they defaulted on the loan, the bank would just seize their house. And that happened to a lot of people. Point being, all these different devices, these are ways to make money, but you have to be very cautious. And there were very few regulations in the 20s. So people investing on the margin, we're talking about 100% margin. That doesn't even happen today. You can't legally do that, but people literally say, give me 100% margin in my investments. A margin call, I should mention too before we go on, and I know this is a lot of financial stuff, but it's really important to understand, I think. This is probably the most practical lesson I've ever taught in this class, to be honest. If you want to just look at like pragmatic, like everyday things, this is the stuff you will make a difference in your life. Anybody here is going to probably buy a house. So margin call, what does that mean? So let's say that I invested in some land on margin, right? Let's say that I took like a 70% margin investment in the bank and I put a lot of money in this land, but the land hasn't really made any money yet. And I keep telling the bank, just give me more time, just give me more time. Well, a margin call is when the bank says, okay, time is up, pay right now, pay. If you can't pay at that moment, then the bank doesn't care. They'll take your collateral and move on. And a margin call is very serious. That's actually this movie right here, Margin Call, as you can see. But if a margin call happens, the bank will forcibly take away the collateral and you'll be left poor. And that happened in the 1920s, at the end, as you'll see. So in the middle of October of 1929, stock market prices sagged. People were buying and buying and buying, then all of a sudden there was a sag in the buying and people started to panic and they all started trying to buy their shares, right? And so what happened is October 24th of 1929, which is called Black Tuesday, is when investors panicked. And all of a sudden you have, oh, I think I got that wrong, Black Tuesday. What is October 24th? Anyways, I think Black Tuesday and Black Tuesday. I think one's Thursday. Anyways, I'll look that up later. But on October 24th, 1929, investors panicked, started selling everything that they could because they didn't want to lose a ton of money. Well, then on October 29th, after 5 days of people selling frantically, the stock market actually crashed. $30 billion in investments were lost. So that was a pretty big deal. Bank runs, basically people were running to the banks and trying to withdraw all their money, and banks don't have all the money on hand. You know, banks will take your money in and they loan out that money to other people in the hopes of making interest. So if everybody were to rush a bank, you couldn't get your money back all at the same time. That's just not how banks work. And so that was crazy. People went from being rich to poor. There were tons of suicides during this time. People were just jumping out of buildings because they lost their fortunes overnight. It's a really sad time. What caused the Great Depression? You know, and this is this is more of a lesson for an economics class. I wish I could teach economics, actually. I'm hoping one day I can because I love it. But people have argued for a long time what caused it. Overproduction is something you'll read in some more left-leaning textbooks, meaning that companies overproduced certain goods, like bikes, for example. Bikes or radios or refrigerators, whatever. People were overproducing certain things, and then they basically outproduced themselves. Like there were too many bikes to go around, there were too many refrigerators to go around. This isn't true because that doesn't really affect the capital of a system. There was an economist, last name Say, and he created what's called Say's Law, and most economists agree that overproduction is not really a possible thing because you can't outproduce yourself with your own wealth. It just doesn't really make sense. There's always a way around that. Some people call it greed and blame it on capitalism because people were investing on speculation and margin investments, and I think that's true to an extent. Yeah, people were being stupid with their investments, but I would contend, and you know, this is an open-handed thing, I think this makes a lot of sense, but I think the Federal Reserve is to blame for everything. Something that most people don't really know much about at all. That's basically where our money comes from, that they're in charge of a lot of things and they have a lot more power than people realize. The Federal Reserve was founded in 1914, I believe, 13 or 14, and it was under Wilson's presidency. And the Federal Reserve basically changed the entire way we do money. It went from being, you know, all paper money backing metal in the bank to, well, you can actually create money that's fake on top of the money that you actually have. And it created this whole game of money that it basically allowed banks to do margin investments, allowed mass speculation. It created the conditions for the possibility. If people didn't have the loosey-goosey currency that the Federal Reserve and central banking created, they would never have been able to do these investments in the first place. But again, that's for another class. But I do want to take some time. I'm going to skip through these slides real quick because I want to tell you guys a little bit about the Federal Reserve. So just bear with me on this. And I know it's a lot of information, but do your best to keep up because this is really important stuff. So what is the Federal Reserve? Well, before we get to that, and this will be the last thing we cover, but before we get to the Federal Reserve, a brief history of banking might be worth talking about. You go way back in the day, and the most basic form of commerce is bartering, right? Hey, I have some fish, as you see in the picture here, and this other guy has a ham, so they're trading actual goods with each other. It's very basic, right? But bartering has its limitations because somebody might have something you want, but you don't have anything that they want, and you'll have to go trade with somebody else to find something they want. It can be a huge game and a mess. So people began to develop common mediums of exchange. And gold has always been something, there's something beautiful about gold. It's shiny, it's rare, it's not mixed with other metals, it's pure. So people began to see gold and other metals as certain currencies of exchange. But gold eventually rose to the top as the best. And you see it in a lot of cultures. So in the original way it would bank though, like what did banking look like in the beginning? Well, if I went to the bank and let's say I have 20 pounds of gold, right? Then I could give my gold to a bank and they would give me paper notes that could be redeemed for that gold at any time. They would basically hold onto my gold, keep it safe in a vault, because it's going to be a lot harder to guard all that gold. And they would give me notes and say, okay, go to any of our banks and give them these notes. These are certified notes and we'll give you your gold back, right? So the bank would give out notes and then they would charge a small fee, of course, to protect people's gold, but they'd have a vault filled with people's actual gold, and then they would give notes. And the thing is that this is what's called 100% reserves. People could, if everybody were to go back to the bank and hand all their paper notes, that should equal exactly the amount of gold in the bank. Because again, the paper money just represented the gold. So that was it. It was very simple. But what happened is over time, and we see this happening in America, ever since the Federal Reserve was brought in, and it's just gotten worse over the decades since, but fractional reserve banking became the new thing, right? And what is fractional reserve banking? Well, basically what it means is that a 10% fraction of every deposit must be put into reserves. And so what happens is this. Let's say that I invested $1,000, right, of my money into a bank, right? What happens is that the bank will take that $1,000 and they'll take a fraction, let's just say 10% of the $1,000. So they'll take $100 and they'll put it in their vault. But they issue that $900 as new money on top of the $1,000 I initially invested. So now they have $1,900. And if it's blowing your mind, it's okay. It doesn't make sense and it's totally counterintuitive. But it's because they consider that money an asset on top of an asset. So again, I invested $1,000. The bank will then take that $1,000, right? And then they'll take a fraction out of it, and then they'll be able to add $900 on top of it. So then I have $1,900. And what's crazy, that $900, they can then loan that out to somebody and then take $90 out of it and then put the $800 and whatever dollars on top of that. This is called the money multiplier effect, where banks are basically able to take a fraction out of people's investments and then just reinvest the money as new money on top of old money. It's called the money multiplier effect. That's the way that fractional reserve banking works. So this is what I'm saying, that's why you have a loosey-goosiness to the money supply that banks are able to use for things like in speculation or specifically on margin investments and all these crazy investments. They would never do this with 100% reserves of gold, but because now all you have to have is a 10% in the vault and you're able to sort of create money to work with on top of that, now banks are more willing to loan money out. In America, the Federal Reserve, so I said 1914, but it was passed literally on Christmas Eve of 1913, so it was essentially 1914. But yeah, the Fed was created in December of 1913, and originally you had to have still gold involved in the process. The Federal Reserve banks had to have 10% gold in the vaults. But that changed to gold and silver, and then eventually Richard Nixon ended the dollar's ability to be converted into any metal in 1971. So this is important to understand, that the American dollar you're holding right now, it's not backed by gold or silver or anything. It's just paper money. Like basically the money's value comes from itself, which is crazy and very dangerous. And if you don't believe me, check this out. This is a 1928 $5 bill. It says here, if you read, redeemable in gold on demand at the United States Treasury or in gold or lawful money at any Federal Reserve bank. Basically, this $5 bill represents actual gold. And you could redeem, if you really wanted to, you could take that money to the bank and get gold in exchange for the dollar, for the note. Here's a 1950s silver certificate. Again, you see that they did eventually open the door to silver being used. Oh, and as a side note, I should mention, our own Constitution says all money must be backed. So it's actually not constitutional that we're completely paper currency, because precious metals were always supposed to be the backing to the American money supply because it creates stability. Anyways, silver certificate from the 1950s. This can be redeemed for silver at any bank. What about today? The modern dollar bill says this note is legal tender for all debts, public and private. What that means is that the note itself is the value. Again, you're not taking a dollar bill and taking it to the bank to get precious metals. It's not like its value comes from backing something else. Money has become its own value system. It's crazy. And when you have paper currency like this, the government is able to print it on demand. Why else do you think we're getting ready to do a $2 trillion stimulus package for coronavirus? It's because the government can get away with doing it. The Federal Reserve is the central bank in the United States. It's actually a misnomer. It's not even federal. It's a private bank with federal oversight. The Federal Reserve has basically all sorts of control over our currency. And again, very few people have even really looked into it. The American Central Bank, or the Federal Reserve, does these things to basically manipulate our currency. So number one is they sell treasury bills, treasury notes, and treasury bonds on the open market. You guys can buy those as investments. They're actually really helpful investments if you want. It's not high interest that you'll get, but it's guaranteed. That's considered the safest investment you can make is in the US government because, well, they have the power to get money however they need to pay their debts. A treasury bill, a treasury note, a treasury bond, basically the only difference is what you're doing is you're putting money into the Federal Reserve and they're promising to pay it back to you with interest. The only difference between bills, notes, and bonds is how many years you're going to wait before you get it back. Like a bond, for example, is over 10 years. So you put money in and then 10 years later, you'll get it back with some interest. Whereas bills and notes are shorter durations of time. The longer you leave it, the more time it has to mature, then the more money you'll get back in interest. So it's just a safe investment. You put money into the Federal Reserve and they'll pay you back with interest later. So they make money doing that. Another thing they do is they modify the reserve requirements. And so basically the Federal Reserve determines, hey, all the banks here, whether you be Bank of America, Chase Bank, whatever, you have to maintain in your vaults a certain fraction of the currency you have, of the assets that you have. So let's just, to keep it really easy, let's say Bank of America has $10,000 total. We obviously know they have a lot more, but $10,000. The Federal Reserve can say, hey, so Bank of America, your total asset holdings are $10,000. You need to have 10% of that in your vault at all times or face penalties. So Bank of America has to always make sure they have at least $1,000 or 10% in their vault at all times. Period. And the Federal Reserve could change that. They could bump it up to 11% or change it to 9%. They could change that reserve requirement if they really wanted. But the main thing they do to manipulate the currency is the third thing here. This is really important. It's called changing the interest rate. If you want to understand, a lot of our economy understand this. Here's what it means. So basically, the Federal Reserve is, again, the central bank in the United States and has federal oversight, and they have a lot of power and money. Bank of America needs to finish each day making sure that they're meeting step 2 here, the reserve requirement. So what do they do if they're lacking? Because let's say you have a lot of people drawing out money or something. Well, what they do is they take a loan from the Federal Reserve. They can technically take loans from other banks too, but it all traces back to the Reserve, or to the Fed anyway. But Bank of America, let's keep it easy. They'll take money from the Fed to make sure they're able to keep up with their requirements for their reserve, right? So basically, Bank of America and Wells Fargo and all these other banks are constantly borrowing and paying money back to the Federal Reserve. So what happens is the Federal Reserve doesn't just do that for free. They charge an interest rate. Bank of America and other banks have to pay them back with interest, right? So what happens is when the Federal Reserve wants to make the economy have a spike, they'll lower the interest rate down. Because when the Fed lowers its interest rate, then Bank of America and Wells Fargo, they lower their interest rates for us, the consumers. Because again, if they're paying back 1% interest to the Federal Reserve, they're only going to charge you 1% interest. What happens during that time is called the bubble effect. And what basically happens is when the Fed sets its rates low, banks set their rates lower, or it's about as low, and then people are able to get money pretty easy. Let's say you want to buy a house, right? Hey, I can go get a loan for $100,000 and it's like 0.5% interest, or it's 1% interest or something. A lot of people are going to take loans because it's low interest, right? And so that causes an expansion of credit in a sense, because you have a lowering of interest rates and more people can afford to get these massive loans to build the houses they want or to buy the things they want. And this causes a bubble to happen. More and more people start doing it. So look at housing, for example. If the Fed's interest rate goes way down and the bank's interest rate goes way down, then everybody starts getting loans, mortgage loans for their houses. And then because everybody's buying houses, that causes the cost of houses to go up because of demand. So now all of a sudden, home builders are starting to build more and more houses because people are buying houses for a lot of money. So you cause a whole sector in the economy to transform overnight. Tons of people get into construction, tons of people are building houses, tons of people are becoming investment brokers, and et cetera, et cetera, et cetera. And then what happens is the housing value skyrockets up and everybody's buying overpriced houses. This is called a speculation bubble. The first speculation bubble happened in the early 1600s in Holland. Look up the tulip speculative bubble if you want to have some fun. It's a very interesting historical event. Same thing happens though with houses and other things. But eventually the Federal Reserve is going to have to raise the interest rate back up. It always does, because it has to make its payments and it has to get that money back. What goes down must come up, and vice versa. So what happens is the Federal Reserve will raise the interest rates back up. The banks in turn have to raise their interest rates back up, and this causes a constriction of credit, and people stop taking new loans from the bank because it's too much money you have to pay in interest. And then all of a sudden, all that money that was going to the housing industry stops, and nobody's buying houses. All the construction companies go out of business that were building houses. All the people in those houses that bought those houses for $400,000. Well, now the demand has gone down. The house value collapses to normal market value. Now it's worth $200,000. Now you're paying money on your home. You owe them $400,000 for a house that was only priced at about $100,000 or $200,000 now in the market. And that's the exact thing that happened in the early 2000s with the housing market crash. So that's the bubble effect. When the Federal Reserve's interest rate goes up and the bank's interest rates go up, and that causes bubbles to pop, and that causes all sorts of calamities to happen. So with all that being said, and I know this has been a long lecture, thank you for tracking along, but I think in the Great Depression that what happened was, if you study the interest rates in the 20s, the Federal Reserve had just become a thing, and they had lowered their interest rates way down, and the banks were doing the same thing. And so people could get all the money they wanted with very low interest. And so people were taking money and investing. And you saw all sorts of sectors of the economy booming because everybody was investing like crazy and buying and using purchasing plans to get things. But then when you study 1929, watch the interest rates, because the interest rate had to go back up. The bank's interest rates went back up. That slowed that process, and people started to panic, saying, "Oh my gosh, I can't afford to buy all these things," or all these big companies that were selling tons of products. All of a sudden, that slows down. So consumers started to panic, and they started buying all their shares because they thought, "Oh my gosh, something's not right with the economy." 5 days later, the entire thing collapses in October of 1929. Total crash. So I would personally think that the central bank is responsible for, with the boom and bust cycle, is responsible for this whole thing happening, I think anyway. Here's a chart of the Federal Reserve's interest rate adjustment since the 50s. I need to find a better chart from the 20s, but they're out there. But you can see how the interest rate has spiked over the years, and in the 70s and the 80s it got sky high. Study when Jimmy Carter was president, and people were standing in line to get gas, and you can see some of the turmoil of the mid-late 70s here. During the 80s, the interest rate spiked really high too during Reagan's presidency. And anyways, yeah, it's some crazy stuff. But here's what I wanted to show you is, look at this, early 2000s, people were making a lot of money on housing, but then the interest rate spiked real high, and that caused the Great Recession with housing. Obama becomes president, right, here in 2008. He becomes president, and you can see that he brings the interest rate down to zero. He didn't do it. I mean, technically the president doesn't have that power, but during his administration and, who he appointed, of course, ultimately, you could have some influence from the president. But anyways, the interest rate went down to zero, essentially zero, for all this time, which, by the way, is unprecedented in our nation's history. And the interest rate has only now begun to climb back out of being zero for years on end. I don't really know what this means. Honestly, I'm a little skeptical of our market because I think we're going to see some repercussions from that. I'm just going to skip this for now. Well, I'll say one thing. Basically, when people were buying houses during that Great Recession, you had prime versus subprime mortgages. Basically, during Clinton's administration, people said it was racist that people who were poor couldn't get money to buy houses because there's a disproportionate amount of minorities that were poor at this time trying to get houses. So the government made it law that you had to give loans to anybody who asked. So a prime mortgage was basically given to somebody who had the means and the reliability to pay off a loan. A subprime mortgage was given to somebody who probably wasn't that self-sufficient and may not be able to pay back the loan for the house. And so it was actually, ironically enough, when the left was trying to help poor people out by giving them access to loans, I would argue they actually made it way worse for poor people because they're the ones who got screwed over the most when the economy turned upside down, because their subprime mortgages, got them into these houses that were worth way more than they could ever pay, and they lost everything. So as usual, the unintended consequences of politics had their toll. If you're confused on this, I apologize. I know I'm trying to pack a lot of information into this last lesson. I wish we had a few classes to talk about this, so I'm sorry. And if you don't get some of it, I don't blame you. But it's really good stuff, and I recommend looking more into it. here's where I'm going to end it though. What's it all about, Ralphie? You know, if maybe you don't like history, maybe you don't like reading history books or whatever, maybe you don't see it as practical. Well, I'll tell you what. I think history is practical because it does give us, you know, a lot to say. You know, it gives us an understanding of who we are as Americans. But I would say even if you want to go about it as a real pragmatic route, here's how this can help you right now if you're going to invest. Watch the Federal Reserve. If you're going to invest in anything, take pulse of the economy by watching what the Fed is doing. Every investor worth of salt does this. When the interest rate is low, houses are going to be artificially high in price. So right now that the interest rates are low, housing is worth, I would argue, more than it actually is. I wouldn't personally want to go buy a house right now, but I know some people disagree with me. But we're not buying a house until we see the interest rate go back up and then everything starts to go back down. So right now I think houses are artificially high in price. Don't take equity-backed loans, like I said earlier. Don't borrow against your own house when the interest rates are low, because what's probably going to happen is the housing value is going to drop at some point and you're going to be owing more money than you should. So don't take equity-backed loans and don't buy houses when the interest rate is really low, I would say, is safer. When the interest rate is high, when the Federal Reserve's interest rate goes up higher, then that's a good time to invest in treasury bills and bonds. That's a good time to invest in certificates of deposit, because basically these are investment instruments that you can take from any bank that's going to be based on the Federal Reserve, and if the interest rate is higher, then the money that you put in will get a higher return. So that's a safe way to make some extra cash. And I would argue it's probably a good time to buy a house. When the interest rates are high, you usually see the housing market start to slump because people aren't getting a lot of credit to buy houses. If you have money saved up, it's golden time for you, because if you can buy a house in cash when the interest rates are high, you're going to not only going to get a nice house, but it's going to go up in value at some point. You'll be able to sell it if you want, or just sit on it. So where are we today? Well, here's the most up-to-date interest rates information I could find for you. Again, you can see that the interest rate went up in the 2000s, causing the Great Recession of the housing market. It went down with Obama, and for several years it was lower than it's ever been in US history. But it started to go back up near the end of Obama's presidency and in Trump's presidency, and it went up. It finally got to the 2% mark, but it dropped back down because of Corona. A month ago it was at 1.75%. Now it's only at 0.25%. So it's actually way down here currently. So that's where the Federal Reserve interest rate is today. And if you have any questions, or if you're interested in learning a little bit more about investing, then let me know. Okay, this week, for our last week of instruction, watch the lecture, which you just did. Kudos to you. There's an initial post and 2 replies for the discussion. I want you to participate in that. Do the Chapter 20 Activity 5 worksheet. Watch CNN 10, leave a comment. And by the way, this is the last full week of CNN 10, so don't get too emotional on Friday. If you hear that emotional music on Friday, this is the last time you'll be hearing it, unless you want to watch it during finals week. But as far as our regular class instruction, it's the last time we require it. And then begin studying for your final. You'll find a study guide in Google Classroom, so just go ahead and pick up that study guide and make sure you're studying that, because when it comes to Wednesday for our final, you have 1 day to get it done. Okay. Well, you guys, I've enjoyed being your history teacher this year. It's been a really good time. And I'll tell you what, I'm going to put up a final video just to sort of sum up my thoughts on history and why it matters. But for now, this is all we have for our instruction. If you have any questions, let me know. And love you guys. I'll talk to you later.